Good morning and welcome to the CT UK High Income Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to the management team. David, good morning, sir.
Good morning, and good morning everyone who's taken the time to listen in on this Friday morning. Thanks very much indeed. So I'm going to go through the slides and talk you through what we've been doing and talk a little bit about the financial performance in the financial year. I'll just pause for a moment on the first slide, the investment risk. You have time to read that properly and note the particular factors that it talks about there. And now on to today's agenda. So we're going to talk a little bit about the trust characteristics. What do you get for the UK High Income Trust? A little bit about performance, primarily to the end of the financial year, but I'm sure we'll have questions later on nearer term performance, and a little bit about that as well. What's different about UK High Income? What is unique perhaps? And then we'll talk about what our top positions are at the moment. Talk a little bit about things that are working, not working. We've got some stock examples if we have time, and then we'll have a forward-looking statement where we'll talk a little bit about what we think is going on in the world today and what that does and doesn't mean for investors in UK High Income Trust. Okay, so what is CT UK High Income Trust? So current investors will probably know this already, but for perhaps a refresher anyway, it's a high conviction investment vehicle. What does that mean? We invest in between 35 to 45 stocks, currently at the top end of that, which means that's a limited number of holdings, and we have conviction in every position we own. We don't own any business just because it's too big or too small. We own stocks that we believe can deliver income and returns for shareholders. Top 10 holdings are around about 40% of net assets. So again, pretty concentrated. They're the positions we have conviction in. And the trust delivers a high level of income, and we believe the prospect of capital growth into the future. So you're not just owning a product that gives you a level of income, but that's all you're going to get. We think you can get, and we have delivered capital growth in the past, can do it in the future. The focus is very much on companies that can grow income, as I said, rather than just pay it now. So what we want to do is better say, okay, we have businesses we've invested on your behalf that pay enough dividends now for us to deliver the income to you. But we know that the dividends they pay will grow into the future, which means we're growing that level of income that we can deliver to you as well. So you can own the shares in the trust in the confidence the level of income that you get will grow over the long run. We're benchmark agnostic. What does that mean? It means, again, to my earlier point, we do not care how big or small a company is. We won't own anything just because it's too big. It's a large part of the index. And we're happy to be contrarian. We base our investments on the work that we do, our own research, using our very strong central research team, based on our meetings with companies. And we're happy to look forward and buy businesses which are improving, even if it might take a little bit longer than perhaps one quarter, which is often what the market's thinking about. We're looking to buy the best quality business models ultimately, and the businesses that may well be out of favour at initiation. The benefit of that is we'll get to buy these businesses at much more attractive prices, and often that gives us then the benefit of a higher dividend yield as well. Columbia Threadneedle has a very large, well-established UK investment team. There's a very strong focused income portfolios. So there's a huge amount of resource behind us. One of the things which is a little bit different at the trust is that we can have up to 10% of the portfolio invested outside the UK. We think about Europe here. We've tried to be quite strict on this, and we'll say we'll only invest in business outside of the UK, listed outside the UK, when they give us a scope to add to things that we can own within the UK market. So they're complementary. We can add exposure to either industries or business models that we just cannot find in the UK market. An obvious example would be technology, where there are limited investment opportunities in the UK, but if we look across Europe, there's a lot more opportunity. And of course, like other investment trusts, we have the opportunity to use leverage to increase potential returns for shareholders. And we generally think that leverage is something, as a unique part of investment trusts, that we should be using most of the time. We're not trying to time when or when not we should be leveraged. We're saying, can we use the benefit of borrowing to increase our positions in attractive business models? So that's the trust. That's what you get. A slide here, which has come from the annual report, which just highlights the point I made earlier about a growing level of income. So as you can see here, we've grown that dividend rate consistently since 2015. In fact, now for the last 14 years, the dividend has been growing every single year. Now, if you can see the increase on the right-hand side, these aren't very high dividend increases, but they're steady increases every year. So all our investors can be confident that we'll look to grow that dividend every year. And of course, we did this even through COVID. So a key characteristic of the trust, the ability and the evidence that we've grown dividends consistently over a long period of time. Get a bit more data from the financial report. Look at the performance. We'll talk a bit more about this in a moment in terms of the returns to the end of the financial year in March. You can see here the net asset value return and the ordinary share return, as well as the B shares and relative to the benchmark. So within the 12 months to the end of March, very strong returns for shareholders. And you see there the distribution per each type of share and the yield. Now the yield on the is now a little bit below this because the market's gone up and the price of the trust has gone up, but we're still delivering about a 5.5% yield a day. And again, crucially, we'll look to grow that. One of the benefits of an investment trust is we can build revenue reserves. And I think it's really important here to highlight that in the year to the end of March, we've managed to rebuild that revenue reserve to more than half a year's dividend. We were able to utilize this during COVID when lots of companies were forced or had to cut their dividends. We're able to utilize revenue reserve to continue to pay dividends to our shareholders. Of course, it's important now that we're in perhaps more normal times, whatever that may mean now, that we look to increase that revenue reserve, said up 26%. So very happy with that in the last financial year. I talked a little bit about performance in the earlier slides. Here is a performance chart itself. And again, this is the end of March. So what we can see here is that consistently good performance over the period from 1 to 3 years. We started running this investment trust, or I started running the investment trust in July 2023, and it had been a difficult period for performance ahead of before that. I think what's very pleasing now is that the performance we've delivered in the last couple of years means that actually we're delivering returns now above the benchmark, admittedly only just 1% over the last 5 years. So consistently strong performance now over a longer time period. You can see that perhaps more clearly in this slide, which looks at discrete annual performance. So this is a 12-month period to the end of March for each year. So the end of March 25, March 24, etc. And as I said, you can see the 2 periods to the end of March 25 and March 24, consistently strong performance. The 12 months before that was a little bit weaker. And then we see in the longer term, it's been quite volatile with some very, very strong performance. 2021, followed by much weaker performance in 2022. And again, as I said, weaker performance in 2023. So we're looking to deliver the numbers you've seen on the left and deliver more consistent returns for shareholders going forward. So we talked a little bit about what we've done differently. When we took on the portfolio in July 2023, in the first 12 months, we made quite a lot of significant changes. We were looking to do a number of things to slightly diversify the portfolio, certainly diversify the sources of income, which was very concentrated in a few stocks at the time, and looking also to think a little bit more about, well, what companies can give us a bit more growth going forward, as well as that level of income. So our investment philosophy remains the same. That's the bit that won't change. We're trying to invest in good quality business models that have a long-term competitive edge. And the long-term competitive edge is very important because that's what enables these businesses both to pay out good levels of dividends now, but also ensure they grow that in the future. Portfolio is still concentrated, but as I noted earlier, we are at the upper end of our range of names. So we've added a limited number of names in the last few years. We will continue to hold European stocks provide opportunities we can't access in the UK, but we have reduced our European exposure over the last 12 months. Partly businesses where perhaps we had less upside, partly things where the market is changing, but also the opportunity set we believe in the UK in terms of the breadth of companies and the very attractive valuations that we see means actually it's quite hard to find opportunities in Europe that are better than those opportunities in the UK, even allowing the fact that we can access different types of businesses. Mid and small caps remain an important part of our portfolio. Some of the names we've added more recently have been in that space. I think, again, that enables us to differentiate us from our peers that perhaps maybe focus much on the larger companies. And as I said earlier, we will not invest in any stock purely for size, yield, or benchmark position, which again leads to the sort of point at the top. So what have we done this differently this year? Well, not that much. Please, as I said, we managed to grow the dividend reserve. So with dividend income generated by our investee companies more than cover the dividend this year. So that was important. That was something we weren't able to do during and just after COVID. As I said just now, we've looked to add to a little bit more businesses where the near-term focus is growth rather than just income. The fact that we're now in the position where the dividend is well covered by our income generation means we can think a little bit more about, well, how can we give our shareholders a little bit more capital growth as well. And stock turnover has been much lower this year than previous years. Again, as I said, we made a lot of changes just after I took the portfolio on in July 23. So what did we change? Well, again, as I just said, not much. This year's been much more at business as usual. We have continued to look to diversify income sources where we can, particularly look for out of favour higher yielding companies. Again, out of favour for the market, but our own work tells us that these are really good businesses. That's always important. As I said, we continue to reduce European exposure. Value in the UK is too high. We have looked and we will look to add value by adding shares that are out of favour and or where yield is higher. And we will look to add ahead of dividend payments. Again, bringing more income into the portfolio, but only if business fundamentals remain attractive. And that's really important. We will not buy businesses ahead of their dividend payment dates just to get income if we don't believe the business themselves are underlyingly positive. Anytime we invest our shareholders' money in a company, we believe we should be looking to own that business for a very long time, not just for short-term periods to get the dividend. The result of all that, it's a strong performing portfolio, we believe, of good quality dividend-paying businesses that we can believe growth can grow both capital, so provide share price gains, and income, higher dividends to our shareholders. And we think that's a very powerful combination and makes the CT UK High Income Trust a very attractive investment proposition. Some of the biggest positives in the 12 months in the financial year, I won't go through all of these in the interest in time, but clearly I'm happy to take any questions anyone has. NatWest Group, I think, is always interesting to talk about. We bought that at the sort of peak of the negativity around the bank, around Nigel Farage, when Alison Rose, the CEO, was forced to resign. We felt at that time, actually, fundamentally, the business was in good shape, that banks were changing dramatically from the position they'd been in the previous decade or so. And we were impressed by the new CEO. So we bought that very well. It was a very strong contributor for us last year, and that's our biggest single positive contributor this year. Interestingly, as I said, we don't own any stock just for its size. And some of our biggest positives have been not owning the likes of Diageo, Glencore, and BP. So that can add value as well. If we were very much focused on benchmark, those would be names that we would own. Rolls-Royce is an interesting business. One might think that not an obvious stock to own in a high income fund. But again, we want to deliver high levels of capital growth as well. And for the first time in many years, Rolls-Royce has also now started paying a dividend, albeit at a relatively low level. I talked a little bit about, we'll look at mid and small caps that we think we can add value there. OSB Group is the not formerly known as One Savings Bank, is a specialist buy-to-let lender in the UK market. It's had some issues in terms of legacy portfolios in the last couple of years, which has meant that we've been able to buy a business that delivers mid-teens return on equity at below its tangible book value. That means it's very attractively valued and also delivers a very high dividend yield that it's grown consistently since IPO. And we can see here one of our strongest performers. On the negative side, Unilever is not a stock we own. We believe the prospects looking forward aren't particularly attractive, but undoubtedly not only it had a better period last year where the numbers were a bit better than expected. Actually, it's given a lot of that back since. So very happy still not to own that stock. Taylor Wimpey, Dunelm, you can see we own some UK domestic exposure. It's something that we think there's a tremendous amount of value and a lot of potential. It's true to say that I think post-election last year, some of the domestics have found life a little bit harder than we might have hoped. And that's continued a bit into this year. So we still think we own good quality businesses. Valuations are even more attractive than they were, but certainly it's been a bit tougher for some of those UK businesses. In terms of our biggest positions now, I mentioned Unilever now, that's our biggest underweight by not owning it. So you can see again on the right-hand side, a number of the majority of our biggest underweights, which means the position relative to the benchmark, are by the bigger stocks that we don't own. In terms of what we do own, which I think is much more important, one of the key factors in all of these businesses, they pay good dividend yields. So the trust pays a high level of income and we need to generate that. Supermarket income REIT, I like to say, is the Ronseal of real estate companies. They own supermarkets, primarily in the UK, Tesco and Sainsbury's, and they generate income by charging the Tesco's and Sainsbury's, obviously, rent for those supermarkets. We believe it's a very defensive business model. It's gone through some structural changes internally in the last year, which we think makes it more attractive. So the management has now moved internally. They've set up a separate JV, which means they can invest a bit further. And it pays a very high level of income. And that level of income has grown consistently in the last 2 or 3 years. So probably not, in this case, the highest capital grown stock. So we don't expect that much share price appreciation. But a dividend yield in the 7 or 8% level, it's very attractive. One of the other things that probably stands out here is there are a number of financials. Legal & General, OSB, which I mentioned earlier, M&G. Obviously, I talked earlier about owning NatWest. And we think the UK financials are much maligned. They all have very strong levels of capital, and they all have high levels of dividend, which they continually grow. So Legal & General is about an 8% dividend yield. Now, it grows only at 2%, but they're also now executing share buybacks as well. So a business that many investors just decide they don't want to look at because, frankly, it's very complicated. Life insurance accounting is opaque and complicated for those who actually understand it. So we find that lots of investors just to put these in the too difficult box. That gives us opportunities, as I said, to buy what we believe are good quality businesses that can provide us a high level of income and growth into the future. And Legal & General and M&G are both very similar businesses within UK life insurance, and both have very high dividend yields. Interestingly enough, both have done transactions recently in the last 12 months where Japanese life companies have taken significant stakes in each of them because they recognize that long-term value that comes in the dividend. Other names perhaps are interested. Smurfit Westrock, an interesting business, used to be called Smurfit Kappa, and then last year they bought Westrock in the US and renamed and actually moved their main list into the US. It was a very strong performer for us in 2024. It's been a very weak performer in 2025 and is been a sort of key negative contributor to performance. Really what's happened here is they have a reasonably large Mexican business, which has got caught up in the noise around tariffs. But more simplistically than that, having bought Westrock, they're a big US player and to some extent susceptible to US growth. And we're concerned around tariffs. That's meant some underperformance of late. Cairn Homes is the largest house builder in Ireland. A bit like the UK, Ireland has a structural shortage of houses. Unlike the UK, the government's done a lot about that in terms of lots and lots of schemes to support first-time buyers, and demand for housing remains very strong. As the largest house builder in the country, Cairn Homes is very well placed to benefit from that. A few examples now. As I said, Smurfit I talked about. They have an exceptional long-term track record of running the business in Europe. Every time they come out of a market downturn, they come out with a stronger position, they come out with higher ROEs and higher dividend yields. And dividend yield has grown consistently for a very long period of time. WestRock has been a business in the US where it's not performed particularly well, and we're very confident that this is the business that the management team can make much better and do the same in the US they've done in Europe. In fact, the US market is potentially much more attractive. With Smurfit buying WestRock, new management teams at International Paper and other consolidation in the market, it's a very well consolidated market, now all in the hands of managers who will prioritize returns over just top line growth. So we think there's a lot of potential here. It's a very attractive value stock, but certainly it's not performed particularly well of late. BT, when we bought BT last year, it's probably the first time in a decade at least that I've owned this stock. Everyone probably has a negative story about BT when you try to get through to the call center or something. But what's interesting here is that the company's been in a multi-year rollout of fibre. So replacing the copper that's been in the ground for 100 years with modern equipment. Now, of course, there's a cost to that. The largest part of the cost is just digging up roads. And that's a multi-year project. We're now coming towards the end, or at least the peak of that capex on fibre. And as that capex peaks, then cash generation will pick up very, very strongly. And the potential for much higher returns from an already high yielding company pick up. Even more importantly than that, once fibre is in the ground, the cost to maintain it shrinks dramatically compared to, again, that very old copper. So it's actually performed pretty well since we bought it. We think there's potential quite a lot to go for over the longer term there. NatWest I've already mentioned, done very well for us, still a key holding in our portfolio, reported results fairly recently, which were very strong again. And while the banking sector has performed very well, and clearly the valuation is less attractive than it was, we still think that there's much more upside to go, and NatWest should be a key beneficiary of that. Ibstock is the largest brick maker in the UK. I mentioned earlier there's a structural shortage of housing, and history, preference and planning mean that bricks remain a key part of that. Now, yes, there are modern housing methods, there are other ways of building things now, but bricks, both for maintenance and for new build, are very important. If we're going to build more houses, then we will need more bricks. Importantly, if you're a brick, you don't care if you're using a private home or a home that's built by a housing association, whatever it is. So we think there's a lot of upside here. They've invested heavily during the downturn, both to decarbonize as much as possible their processes, but also invest in more efficient equipment and more modern equipment. Balance sheet's attractive. The valuation, I think, is very attractive. But as I'm sure many of you have read, we're not actually building that many houses at the moment. The government's working quite hard to try and change things on the supply side, but we probably need interest rates to be a bit lower and a bit more consumer confidence. And that was sort of seen in Ibstock's recent results, which were a bit disappointing. The shares have been quite weak recently. We're very confident that the business will recover, but we need the housing market to recover, or volumes to recover first. So continue to hold the business. Smaller company, but a very strong position within its market. So looking forward, what do we think from here? Well, last year at the AGM, we talked about stability because we had a new government that had 5 years ahead of it. Well, that's probably about the only thing we have from the government in terms of stability. We've had probably one of the worst budgets in terms of what was suggested ahead and what actually happened. We've seen the negative impacts of, for example, national insurance coming through now. And it's fairly sure that we'll probably get more tax rises as we go into the budget this year because growth has been weaker. But as I said, the government has worked quite hard behind the scenes, and we're hearing that there are signs that supply side reforms are starting to work, particularly around housing, as I said. Unfortunately, it does take time to free up land. And even once the land is been given planning, house builders need to see the prospect of a pickup in sales to make it worthwhile starting. So that's probably going to only come to fruition in 2026, which is disappointing, but we think it's a delay rather than something that won't happen at all. We think the UK market remains very attractively valued. And in fact, we can see that the UK has actually been one of the stronger markets this year, often the UK performs well in weaker markets. We've had positive equity markets, and the UK has been one of the stronger markets. Again, we think that's important, and investors generally are starting to recognise the valuation attractiveness in the UK. Not only do we think it's being recognised by investors, increasingly recognised by corporate buyers and private equity. It does appear that there's certainly not a week go by. Sometimes it feels like another day goes by when we don't see private equity or corporate buyers buying UK companies for us. We had an interest rate cut this week. Clearly, sentiment says we might not get many more now. We'll have to wait and see. We should remember that 4% in UK history is actually not an unattractive level of interest rates. And this will help support the housing market, as well as the fact that 5-year rates are coming down. So 5-year mortgage rates have come down. So as a backdrop, we think the UK High Income Trust is well positioned. We believe we can provide shareholders, crucially, with that high-end growing level of income, alongside strong potential capital growth, both from our UK businesses, but also selective European investments. I'm just going to leave you with a disclaimer so we can see that slide there. And now we'll hand back. I'm really happy to take any questions that anyone might have.
David, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation. Can I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Yes, thank you very much. And thank you everyone for joining us this morning. Thank you, David, for running through the presentation. My name is Peter Brown. I work as part of the investment trust team at Columbia Threadneedle, and I'm going to moderate the questions coming through, and I thank you for them, and I encourage any further questions if you have any. David, we've had a couple pre-submitted questions, so we might as well start with that. The question starts, why has the increase in the FTSE this year not been reflected in the share price of this trust? What I would say before you start is that the FTSE obviously is the FTSE 100, or it could be the FTSE All Share, and the benchmark of your trust is the FTSE All Share, which does change slightly as far as performance is concerned. And if you look at the fact sheet, which is as of the end of June, which is available on the website, it doesn't necessarily suggest that. It says the year-to-date performance of the NAV is 10.4%. The share price is up 12.8%, where the benchmark is only up 9.09%. But maybe you can give a little bit of a chat about the share price and the NAV from the beginning of the year.
Certainly, thanks very much, Peter, and thank you for the question. It's been an interesting mixed year, I think, in that January was a very difficult month. The UK market reacted very badly to rising interest rates, driven actually by the US, not really by the UK. And then we had some pretty strong performance February and certainly in March. April, the trust performed well in a very volatile period. If you think post Liberation Day, markets were all over the place, and the trust performed quite well because it has a portfolio of good quality companies with high yields. And then we struggled a bit more during May and June. Now, it may be you're looking up to date and you looked at performance at the end of July. July was a more difficult month. I talked earlier about we own a number of UK domestic businesses, the house builders, the banks, some of the retailers, the brick stocks, and they have had a difficult time in July with some companies, Ibstock, Breedon, another infrastructure company, particularly talking about delayed impact on profits. Some of that's about weaker UK housing, some of that's about bad weather in the US, in Breedon's case. So, yeah, to the end of June, actually, performance has been okay. I think we have had a weaker July, and maybe that's what the question is talking about. I would say markets are probably more volatile than I've ever seen them, so I wouldn't pay too much attention to near-term performance. Again, I'd focus on the fact that we believe we own good quality companies. There's a lot of pent-up value there. I think it's certainly fair to say, as I talked about in the presentation, that some of those values taken a bit longer to realise.
Thank you. Moving on, completely different tack. I'm not sure if you can answer this, but I'll share the question and see how we get on. Do you, as a listed investment trust, pay any tax on any chargeable gains? Why should the government continue with that exemption for listed trusts and unit trusts? which is not available to other listed companies?
So we don't, and provided the company remains an approved investment trust by HMRC, it's not liable to capital gains. And as the question says, that's true of unit trusts as well. Why should the government carry on doing it? I mean, I guess they always have. One can see it's an incentive for people to invest in pooled investment vehicles, because I think if the trust was subject to capital gains, it would get very complicated, but clearly that has an impact on returns. So we don't see any prospect of that changing. It's been the status quo, as far as I'm aware, for a very, very long time indeed. But yeah, so that's the answer we have for now.
And possibly the same question setter. Do you make any calculations of chargeable gains each financial year and how much tax you would have to pay to HMRC if there was a removal of the exemption?
In the annual report, there is full disclosure of all the capital gains for each year. We don't make it a calculation because we do not believe that the situation will change. But clearly, if any investor wanted to think about what the impact would be, the capital gains are disclosed.
Lovely, thank you. Back to the portfolio then. You mentioned the financials in quite a bit of detail, but the specific question is how are you viewing the banking sector exposure now, given the returns on equity and dividend strength?
I mean, pretty positively. We have positions, as I said, in NatWest. We have a position in Lloyds, which had the benefit last Friday of the Supreme Court decision on motor. We also have a position in HSBC and Standard Chartered. Standard Chartered is slightly different. I talked earlier about wanting to think about how we can give a bit more capital growth now that we're in a good position for dividends. And Standard Chartered we see as the next leg of banking growth. They've not been a big beneficiary of the rise in interest rates because they don't have the huge pool of cheap deposits in Hong Kong that HSBC does. But what they have done is invested heavily in their wealth proposition over the last 5 to 10 years, and that's in Asia. We think that can be a source of growth going forward. As far as the UK banking sector is concerned, they've never been, I don't think, in a strong position. Capital levels are very high. Dividend yields are very high and very easily paid. And we think they remain really good investments. What we do need is a bit of growth, to be fair. We've not seen a lot of growth in lending. If we can see that, then that'd be a really big positive as well. But even as we sit here today, with the levels of dividend yield and share buybacks, we're getting double-digit returns pretty much without doing very much else.
And remaining on sector exposure, questions come in. Do you take a sector neutral approach or are you comfortable with large overweights?
We're very comfortable with large overweights. Again, this is benchmark agnostic. I talked about we won't buy any stock just because of the size of the position, the benchmark. Same for sectors. So we will take big overweights. So I mentioned the life insurers in my presentation. So we have a big overweight to the life insurance sector. We own M&G, Legal and General, and Phoenix. All do slightly different things, but all pay around 8% dividend yields. So when we have conviction and we have valuation support, then we're very happy to take big overweights.
Next question. How important is valuation discipline versus dividend yield when buying a stock?
Very important, although I put them both together, really. Dividend yield is to some extent, it is another way of thinking about valuation. So we will look at them together. So if we have a stock that's got a high dividend yield and a high, for example, price to earnings ratio, then we might question how that's come about. Maybe it's over distributing and paying out too much cash. But yes, I think what's more important perhaps is the quality of the business. So we won't buy something that has a high dividend yield. We don't think it's a very good business. But this business has to be something that will pay that dividend and grow into the future rather than just paying a high dividend yield now, because actually it's got no future prospects. But valuation and the dividend yield are crucial parts of how we look to invest in companies.
Thank you. Next question, and thank you for all these questions. They're really good and very interesting. What's the average holding period for stocks in the portfolio?
We like to quote Warren Buffett quite often, which is the best holding period is forever. The reality is that is the case for some companies, that they will provide that level of dividend income and grow into the future. and sometimes either the valuations get too demanding, or sometimes, unfortunately, the thesis doesn't work. In this particular portfolio, as I said, we did a large amount of turnover when I took the portfolio on in July 2023. So the average holding period would be less than normal. What we always think about is we think about 3 to 5 years. We think that's the right sort of life cycle that businesses or management should be investing, and we should invest alongside that. But certainly there will be companies that we own for a very long time.
Thank you. The discount reduced noticeably within the last year. What was the reason for that?
I mean, the simple answer is that we had good interest from prospective shareholders and existing shareholders, and the fact that we had therefore had more buying than selling brought the discount in. I mean, we've worked quite hard in the last year to do events like this to make sure we're talking to all our shareholders and potential shareholders, and that's driven some interest. I've done events like the Master Investor Show. I think also, if we go back 2 years, as I said, and we saw on the performance chart, performance had been pretty volatile, some sort of pretty strong years and some not very strong years. And I think the changes we've made to portfolio in the last 2 years have given investors confidence that we can deliver consistent level of income, let it grow, and that's helped demand. And that demand for shares has helped bring the discount in. And I also think in an environment where, again, UK base rates now down for 4%, I'm not quite sure what you can get from a bank these days, probably that or a bit less if you search very hard. A dividend yield of 5.5%, which is lower than where it was because obviously the share price has gone up. That's a yield, as I said, we think will grow, well, we believe strongly will grow over time. I think that's just a very attractive investment for investors.
Yeah, I would agree. I think from my sales point of view, an increase in the yield over benchmark plus a capital appreciation is very attractive, and that's why we saw the buys into the share price. We'll finish with a couple about exposures. Do you see scope for increasing exposure to Europe or other overseas markets?
Well, when we think about overseas, it's really thinking about Europe. I think the US, for example, or Asia are markets where we wouldn't, certainly within our team, profess to have the expertise to really start playing around. I also think if you were to start seeing Amazon or Nvidia in the portfolio, then shareholders should be questioning that. So Europe, yes, I can see scope for increasing exposure. But the only thing is, it's the type of companies that we look to buy, which again, as I mentioned earlier, businesses where we want to get something different. I'm not going to buy a European bank just because it's cheaper than the UK bank. I don't think that's what we should be doing with investors' capital. If we can buy businesses, so we own at the moment, the European stock we own is SAP, which is one of the world's largest software companies, an absolute beneficiary in AI, and that's grown very, very strongly. They talk about 26% growth in free cash flow. That's a great business. There aren't many of those around, and they tend to be very expensive. So that's the thing at the moment. When we look at how we allocate our capital, it's, well, we can buy some really good business in the UK that are pretty attractively valued and often have good levels of dividend yield. We'll look at Europe, where yes, we might get some more growth, but we're paying quite a lot for that, and there's no income. So I would like to grow the European exposure. I think it's an interesting characteristic of the trust that others can't do, but it's determined by the opportunity set we have in front of us.
Quick question here, just come in. UK market flows have been very challenging for an extended period. How important do you view buybacks as a method to offset this?
Yeah, I mean, I do think it's important. I think it's important for two ways. The first one, which is sort of implied by the question, it's hard for shares to go up if someone's selling them all the time. So if you've got a company that has the ability to buy back its own shares, then clearly there's a buyer there, and that's helpful. Secondly, it's a clear sign that management have confidence in the future, and that they believe at least their shares are attractively valued. It also can be very powerful in terms of driving returns in the future. If you think about Imperial Tobacco, one of our biggest holdings, clearly the number of smokers is declining all the time, particularly in the UK, less so in parts of Europe. But their cash flow is so strong that actually earnings are growing because they're buying back, the shares are cheap, they're buying back so many shares that actually the dividend can rise just by the number of shares in issue being reduced all the time. So I think buybacks for UK companies are an important support. We applaud Illegal in General when, rather than, they used to grow the dividend a bit higher, but they grow the dividend now at 2%, but look to use surplus capital to actually buy back their shares, because frankly, that's an incredibly valuable purchase. So yeah, we do think it's important.
And the final question, what is your view on the outlook on UK equities over the next 12 to 24 months? And you may want to reference again the bank rate yesterday being cut, and your thoughts on where that could be in the next 12 to 24 months too.
Yeah, so as I said, bank rates come down again to 4%. Interestingly enough, actually, if you look at the UK government bonds, the 10-year has been quite high, but the 2-year and the 5-year has been consistently lower anyway. And I talked about 5-year mortgage rates. That's probably the most important rate for the UK consumer. But certainly, bank rate coming down, it gives confidence. Now, the vote in terms of the 4-4-1 split and the revote hasn't given the market the greatest confidence that we'll see more cuts this year. I mean, I think we may see one more because there are clear signs the economy's slowing. And as I said, we'll undoubtedly see more tax rises in the budget. But like I said earlier, I mean, we're still pretty constructive in the UK that it's definitely been slower than we'd have hoped a year ago. The budget didn't help. Some of the sort of rhetoric from the government hasn't helped, certainly earlier. But there's clear recognition now that they really do want to drive growth, and perhaps they didn't really appreciate maybe how to do that. But the supply side reforms, I think, would be crucial. So we remain pretty constructive on UK and UK equities. We are still more disposed towards domestics. We're seeing businesses that have a large US revenue base going to get hurt by currency, and frankly, who knows what's going on in the US in the next 12 months. It changes on a whim on President Trump's, whatever he seems to think when he wakes up in the morning. So we think the UK is a good place to be. The valuation is attractive. There's a lot of pent up demand, certainly for housing. So we're relatively constructive, but we definitely acknowledge we've not had the last 12 months that we were like post-election. But going forward, we're sort of okay. So yeah, happy enough with what we got, but we do need to start seeing some growth develop, and we probably need to get through the budget to see where the tax rises come.
Lovely, and thank you everyone for your questions. We'll end it there, but if you can just give a final quick summary, David, and then we'll hand back to the moderator.
Yes, okay, thank you very much. Thanks everyone for your time, and really thank you for the questions. It's always great when we get some really interesting questions that we can use to sort of discuss what's going on. So look, we think the trust is in a really good place. We think it's a really attractive investment. The combination of a high yield, a growing yield, the prospect of capital growth, and the ability to use leverage to enhance returns makes an attractive proposition. The UK has a number of really great companies. Domestic backdrop, as I just said, has been a bit tough. We think there's a lot of potential there, and therefore it's a pretty exciting place for the UK going forward. Not least because other markets, notably the US, are perhaps looking less attractive than they have done in some considerable time. So thanks very much for your time. I really appreciate it. And for those live on the call, have a lovely weekend.
David, Peter, thank you for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of CT UK High Income Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.